we go. We're live. How are we doing? We are live for our first Finance Friday. So it's 4 o'clock. First one of these. We're going to be doing lots of these going forward. But the first one that I wanted to do was really just a Q&A. So what I did is I put a message out to everyone on the TSC database and said, look, if you could have any questions answered, what would they be? So I've got a list of those ready to go. So we'll go through those very shortly. But also, if you guys have got questions, then we will go through those as well. So in the comments box, I just want to know, can you see my face, see my screen? Just give me a shout in there if you can. And then we'll jump to screen share because I want to do some stuff on the charts as well. Great stuff. So we'll start with the questions that people sent in, and then I will come in with some of the questions that you guys have got. So if you've got questions, get ready because I will go through those as well. Brilliant. Here's Barry's here. Greg, nice to see you, mate. UB boys are here. Good stuff. Eugen is here as well. Good to see you. We'll have you on here soon, mate. David Brooks, good to see you. Right. Jordan, good afternoon, sir. You've got some questions in our Telegram group that I will come back to as well. So I know you've posted up some trades and some stuff to get reviewed there. So I will come back to you on that. Right. So let's go. Let's start with the first one. And this is from one of our members, David Carter. So David is asking, how do you account for margin when you are in multiple positions? So I'm assuming what David means by that is if you're going to be in multiple positions or you're planning to be in multiple positions, how do you account for the fact that you need a certain amount of margin per trade? And what happens if your margin is used up on trades that have come before? Well, the simple and basic answer to this, if that is the case, and sometimes when you're swing trading, you get a period of time where lots of trades come through at once. So they're a little bit like buses. So you get a load of trades come through in one go. So you might have no swing trades for a couple of weeks. And we had this just before Christmas. We had 20 possible trades across out of 40 markets. And at one point we had 6 trades come in all at once. So for some traders, that's going to be an issue with margin. All right. So what that basically means is you've got to have a certain amount of money to be able to place each trade. Now, the challenge for most traders is that they are risking too much. So the challenge, David, is I don't know how much you risk per trade, but if you're risking no more than 2% per trade, and if you're day trading no more than 1% per trade, then the chances are that is not going to be as much of an issue for you. And the reason why is because you're risking a small amount. So you should be able to get into at least 4 or 5 trades. Now, obviously, if you have a scenario where you've got 3 trades running and 3 or 4 trades ready to go, you don't know which out of those 3 or 4 ready to go are actually going to end up as trades. So they're sitting in your watch list. So I'll show you a watch list in a second. So they're sitting there in a watch list. And the challenge in that scenario is you can't predict that. So all you can do is trade the setups that's there. The challenge comes if you're day trading and you're trying to trade too many markets and too many strategies at once. And the reason why, and I'll just get the share screen up so you can see it. Bear with me 1 second here, guys, so we can get this, because it's easier if I just draw this. So one of the things you've got to bear in mind, if you're day trading, then the chances are, if we're looking at a trade, so we use a pullback as an example, if that's a swing trade, let's say your entry is here and you're doing a standard 2-to-1 on the trade, so your stop is down here, that distance, because you're trading off of the daily, the 4-hour, or the weekly chart, that distance might be 100 points. So the number of points there is greater. So let's say you're running a 10,000 unit of currency account. You're going to risk 1% on that trade. You're going to risk £100, $100. You're only going to be risking £1 per point movement or whatever it is relative to lots. But if that was a day trade, that distance there might be 10 points or 20 points or whatever it is. It will be smaller than if it's a swing trade. So if it was 10 points, then straight away you can risk 10 units of currency per point movement. So what will happen is the broker will see what it is you're willing to risk on the trade in terms of what's called your stake, which is the unit of currency you've got here. So if you're day trading, most scenarios are going to mean that the stake, the amount of currency that you are risking per point, is going to be greater. So as a result of that, what they're going to do is have a higher margin requirement on that particular trade. So they're going to need you to have a bigger amount of cash to cover that trade. And you might say, well, I've got a stop in place. So what's the problem? Well, the broker assumes the worst. The broker assumes that you may not keep your stop in, or you may have a stop and choose to take it out a little bit later. So the key thing here is, if you're day trading, then the chances are you are going to need a greater amount of cash relative to the size of your account per trade you place. So as a result, you're not likely to be able to be in 10 day trades at once. But my argument, if you were talking to Kerry or Martin, who are our day traders, our argument would be, if you're in 10 day trades at once, then you've either got to be risking a very small amount, 1% probably lower, 0.5% per trade. And invariably, that's probably too many trades, or you're probably trying to trade too many strategies across too many markets. So invariably, I don't really worry or need to account for margin. And the majority of traders spend too much time worrying about margin. And the reason why is because they are risking too great a percentage of their account. They might be risking 5 or 6%, or even sometimes 10% of their account. I worked with a lady that was following some of the strategies we were running, but she was risking way too much. And I said to her, I'm not going to work with you any longer unless you absolutely reduce the amount you risk per trade, because psychologically it's too much. I've been trading for 20 years, but if I was risking 10% per trade, I wouldn't sleep at night. So it's very, very important that you focus on managing the percent you risk per trade rather than worrying too much about margin. All right. So good question. Thank you for that one. So let's go. So I'm going to come out here. You have to forgive me, guys. I'm just getting used to this new bit of software. So just bear with me. So